Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to summarize the Canadian bank stocks earnings report and compare these reports for the 7 largest publicly traded banks in Canada. I divided these earnings report into 5 categories of great, good, okay, bad, and disaster depending on the numbers and financial figures reported in the earnings of each bank. I personally invested in 2 Canadian banks at the moment, TD Bank and EQ Bank, and that's why I read the earnings report of Canadian banks carefully and follow their news. I will start with EQ Bank as the 7th largest Canadian bank with a market cap of almost 2.5 billion Canadian dollar, and it is the smallest bank by market cap in this list. I think the earnings report was actually great. I already covered the earnings of EQ Bank in detail in a separate video on the channel, so if you want the details, you can watch my recent video on EQ Bank earnings. Overall, they reported great growth and profitability numbers in pretty much all aspects of their business. Adjusted Q1 revenue was up 40% year over year. Adjusted net interest income was up 45% year over year. EQ Bank customers up 26% year over year, and deposits were up 12% year over year. Their adjusted return on equity is 16.9%, which I believe is an all-time high for the company. In terms of the risk management, common equity ratio is an important parameter. CET1 ratio basically compares a bank capital against its risk-weighted assets to determine its ability to withstand financial distress. The regulator recently increased the minimum CET1 ratio for banks in Canada, and now effectively from February 2023, the CET1 ratio requirement is set to be 11%. In terms of the risk management, the total capital ratio of EQ Bank was 15.5% with a CET1 ratio at 14%, which is healthy. Another important profitability metric that I like to look for a bank is net interest margin, which is an indicator that measures the net interest income a financial firm generates from credit products like loans and mortgages. In summary, a positive net interest margin, or NIM, suggests that a bank operates with a positive profit, while a negative figure implies investment inefficiency. The NIM of EQ Bank is up to 1.92% or 9 basis points year over year, which is really good. As you can see here, they increased their NIM consistently in the last 5 years, which I like to see this trend for EQ Bank. They also increased their dividend yet again by 6% quarter over quarter or 28% year over year. They basically continue to increase this dividend every single quarter by 6 or 7%. All in all, solid numbers across the board, and I think EQ Bank earnings report was definitely great and deserved to be the top of the categories in this list. Valuation-wise, EQ Bank currently trades for a price-to-book ratio of 1.05, which is still lower than its 5-year average of 1.1. It basically trades at its book value at the moment, which is, in my opinion, a very good time to invest in this growing Canadian bank. The second earnings report that I'm going to look into was the earnings report of National Bank. National Bank is the 6th largest Canadian bank with a market cap of almost 33 billion Canadian dollar, and I think their earnings report was good. 3 important metrics in the highlights of their earnings report. Diluted earnings per share was down 6% year over year. Return on equity was also down from 20.7% to 17.5%, still a good number, and their CET1 ratio is at 13.3%. The main reason that the diluted EPS and net income was lower this year was simply because of the higher provisions for credit losses, which they mentioned is a reflecting of deterioration in macroeconomic factors. So the reduction in EPS and net income was simply because increasing their capital ratio to manage the risks. Other than increasing CET1 ratio, the revenue itself was barely up year over year, which I don't really like it much. Revenue was up only 2% year over year. It means National Bank growth was extremely slow, which is a little bit concerning. One thing I liked in this report was that their net interest margin was up to 2.09% from 1.93% last year, which is great. They also raised their dividend to $1.02 from 97 cents per quarter, which is again good for shareholders. While it feels like their online platforms are a bit outdated compared to the competition, I like National Bank. I use their self-directed brokerage account myself, and I think they still have a lot of room to grow and expand their business in future. Overall, not really an amazing report like EQ Bank, but it was overall better than expectations, especially in terms of net interest margin expansion. So I think it's fair to say that earnings report of National Bank was overall good in this quarter. Valuation-wise, National Bank currently trades for a price-to-book ratio of 1.59, which is still lower than its 5-year average of 1.79. In my opinion, National Bank is not optically cheap like EQ Bank, but it is slightly undervalued here. CIBC is the 5th largest Canadian bank with a market cap of 52 billion Canadian dollar and the next bank that I will recap their earnings. And I think their earnings report was bad. I guess it wasn't disastrous like their previous reports, but it is still bad. They increased their provision for credit losses on their loans like other banks, which caused reduced earnings for this quarter. 4 main metrics. Revenue was up 6% year over year, which is good. Adjusted EPS was down 4% year over year. Adjusted return on equity was down from 15.2% to 13.9%, and their common equity tier 1 or CET1 ratio up slightly year over year to just 11.9%. As you can see, CIBC has a lower common equity ratio than National Bank and EQ Bank, and if regulators increase their minimum capital ratio in future, CIBC has to put more liquidity aside to increase this ratio, which will lead to even weaker EPS and income numbers in the coming quarters. They also reported a weak net interest margin of only 1.4%, which is one of the lowest margins between all Canadian banks. Overall, I don't really see good numbers here in this report. I think this was another weak earnings report for CIBC, and overall, I don't really think they are in a good shape at the moment. Valuation-wise, CIBC currently trades for a price-to-book ratio of 1.14, which is lower than its 5-year average of 1.39. In my opinion, if you factor in growth potential and risks, CIBC trades close to its fair value today. Bank of Nova Scotia is the 4th largest Canadian bank with a market cap of almost 80 billion Canadian dollar, and I think their earnings report was just okay. Their diluted EPS was down year over year by over 20%. They increased their provision for credit losses on their loans like other banks, which caused reduced earnings for this quarter. Their adjusted return on equity is at 12.4%, which is down from 16.4% last year. And this number I think, is one of the lowest numbers between all the Canadian banks at the moment. Their common equity tier 1 is at 12.3%, and similar to CIBC, they may have to raise this ratio if economic conditions get worse in the future quarters. Despite this not great matrix, they raised their dividend slightly to $1.06 per share per quarter. The only metrics that I can give them a pass is their net interest margin, which is at 2.13% at the moment, which is slightly down from 2.23% last year, but at least it is a good margin. They didn't report any great number, but I think market expected a total disaster from Scotia Bank, and this report was not a disaster, so market actually liked their report. Overall, this wasn't a good report by Scotia Bank, but it wasn't a disaster either, so I think it's fair to say it was an okay-ish report. Valuation-wise, Bank of Nova Scotia currently trades for a price-to-book ratio of 1.16, which is still lower than its 5-year average of 1.37. In my opinion, Bank of Nova Scotia is slightly undervalued today. The next earnings report that I cover is related to Bank of Montreal, which is the 3rd largest Canadian bank with a market cap of 82 billion Canadian dollar. I think their earnings report was actually bad. It wasn't terrible and all negative, but it wasn't a good report either. They increased their provision for credit losses on their loans like other banks, which caused reduced earnings for this quarter. Their adjusted diluted EPS was down year over year by almost 10%. Their adjusted return on equity is also down to 12.6% from 15.7%. Their CET1 ratio is at 12.2% compared to 16% last year, which is not good at all. However, their adjusted net interest margin was up slightly from 1.63 to 1.7. They also see a growth in their deposits, assets under management, and overall assets of the company, which are good. Overall, some good numbers and some concerning numbers in this report, and I think overall this was worse than expected report for BMO. So I think Bank of Montreal earnings report was overall bad. Valuation-wise, Bank of Montreal currently trades for a price-to-book ratio of 1.14, which is lower than its 5-year average of 1.38. In my opinion, BMO is slightly undervalued at the moment. For the next earnings report, I will look into TD Bank. TD is the second largest Canadian bank with a huge market cap of 145 billion Canadian dollar. And I think their earnings report was just okay. They had a few one-time expenses during this quarter, including the mitigation of impact from interest rate volatility to closing capital on First Horizon acquisition for $134 million. They have a foreign exchange loss related to Stanford litigation settlement for $39 million and also other one-time expenses. On an adjusted basis, this was one of the few quarters that TD diluted EPS was down year over year by almost 5%. They increased their provision for credit losses on their loans like other banks, which damaged the bottom line results. Their total deposits were basically flat year over year, which is again another concerning number here. Their adjusted return on equity is at 14.1%, which is down year over year. On the positive side, their CET1 ratio is at 15.3%, which is pretty good and up year over year. And finally, their net interest margin is at 2.74%, which is absolutely amazing. I think it's the best NIM between Canadian banks. Overall, some great numbers here on profitability and risk management, and some bad numbers on growth metrics and also one-time expenses for the business. That's why, in my opinion, this was an okay report for TD Bank. It wasn't good at all. Valuation-wise, TD currently trades for a price-to-book ratio of 1.38, which is still lower than its 5-year average of 1.65. In my opinion, if you factor in the quality of TD business and track record of the management team, TD is relatively undervalued here. The last earnings report I covered today is related to Royal Bank, which is the largest Canadian bank and Canadian company with a market cap of 172 billion Canadian dollar. And I think their earnings report was also good. They increased their provision for credit losses and allowed an allowance for credit losses like other Canadian banks, but overall their earnings was okay-ish this quarter. I would say it was good this quarter. Their adjusted diluted EPS was down 11% year over year. Return on equity was down to 14.9% from 18.6%, and their common equity tier 1 or CET1 ratio is at 13.7%. On the positive side, they increased their quarterly dividend slightly by 2%. Their net interest margin is at 1.53%, which is up slightly year over year. Their total revenue and assets were up year over year, which are all good aspects of this report. Overall, I think it was a good report overall for Royal Bank. Valuation-wise, Royal Bank currently trades for a price-to-book ratio of 1.66, which is still lower than its 5-year average of 1.91. In my opinion, if you factor in the quality of Royal Bank business and track record of the management team, Royal Bank is also relatively undervalued here. There you are, guys. I hope you enjoyed this video, and if you enjoyed the video and my coverage of earnings report of Canadian stocks, consider subscribing to the channel to see similar videos. Thank you for watching, and I hope to see you guys in the next video. Farewell.